Well, lately, the Trump administration has been tossing out all kinds of ideas left and right to try to help make homeownership affordable. How many of these ideas will actually help you, and how many of them are just going to make the problem worse? Let's talk about it.
Welcome to the Utah Homebuyers Quest podcast with Nelson Bars. Our mission is to give you hope, knowledge, and encouragement on your quest for home ownership.
Housing affordability is at its worst point since 1986.
Higher mortgage rates are impacting Utah's housing market. Potential buyers out there being priced out.
It's getting tougher by the day to afford a home.
Many factors are making it very, very difficult with no relief in sight.
Homeownership may seem like an impossible mountain to climb in today's world. We're here to say that it is possible, and we're here to be your guide, to climb with you, to urge you forward all the way to the closing table. We believe in home ownership, and we believe in you.
So lately I have found myself conflicted. I really love to see our government trying to help home buyers, but some of the proposals give me a very uneasy feeling. Like I want to say, thanks for thinking about us, but please just don't. Just go think about something else. Fix another problem. Because the biggest fear I have is unintended consequences. Here are a few things I know about our world. Politicians say and do things that they think will help them or their party win the next election. And federal elections happen every 2 years. So there's a lot of short-term thinking, right? These proposals are focused on short-term benefits. They're all about what can we do now to get housing costs down as quick as possible. A lot of the proposals are focused on demand, helping the demand side of the problem, focused on giving buyers a leg up, not because that's going to fix our housing problems, but because there are a lot of voters who would like those promises. So please understand, I'm all for helping buyers. That's my career. I help home buyers, and I am in favor of things that help home buyers. But you have to recognize that the reason why our house prices have gotten crazy is due to too much demand and not enough supply. So I get uneasy when anyone puts out a proposal that will only exacerbate that problem. Because in the end, any policy that ramps up demand, like anything that helps buyers save money, is going to lead to higher home prices in the long run. And so you're going to help the current generation of home buyers, but you'll hurt the next generation. I mean, that's exactly what happened over the last decade. The government gave us 3% interest rates. It really helped. But it drove up prices a lot, and it hurt the current generation of home buyers. Now, some of these proposals do address the supply and demand imbalance, and I'm going to point those out as we go. But let's look at each proposal individually. Let's see if they'll be good for you, good for our market, or both, or neither. Okay, so I'm going to break this down into 3 categories. We're going to talk about things that may never happen or may be far in the future from ever happening. Then we'll talk about things that are happening right now. There's a lot going on right now that's moving the market. And then third, let's talk about things that the government has been doing for a long time to help you. And then at the end of the episode, I'm going to take a minute and address how these affect you positively, even if they affect the market negatively. And you might be surprised at my advice. Okay, so let's dive into some of the proposals that might happen, might not happen, probably not at some point in the future. And the first one is the 50-year mortgage. There's been a lot of buzz about that over the last month or two. I'm pretty sure when it was announced that President Trump wanted to change our mortgage market to allow a 50-year mortgage, it probably gave Dave Ramsey a heart attack. And fortunately, it's probably not going to happen anytime soon. There are regulations in place that prevent our government from participating in risky mortgages, and by their own definition, this would fall into that category. I did an analysis when they first announced this. I almost did a whole episode on the 50-year mortgage idea. And what I learned is that it would probably come with a higher interest rate, right? Even now, if you want to go from a 15-year mortgage to a 30-year mortgage, the interest rate is about 3/4 of a point higher because of the longer term. So if that logic holds, a 50-year mortgage is probably going to be 3/4 of a point higher than a 30-year mortgage. And if you factor that in, the monthly savings is going to be almost nothing, maybe $150 a month or something like that on a typical home. What people really hate about this proposal is that on a 50-year amortization, you're going to pay so little principal, right? I think that's a little bit of a non-starter. We already have a lot of mortgages that are interest-only mortgages. So interest-only means you pay zero principal every month, and they technically could go on forever if they didn't have termination dates in the contract. And so a lot of mortgages are that way. Anyone who has a HELOC, a second mortgage, home equity line of credit on their house, has an interest-only mortgage. So in and of itself, the 50-year amortization, it wouldn't kill anybody. My problem is that if we did this large-scale move that lowers home payments $200 across the board for everyone, it would only result in driving up the prices until we get back to this same payment level that is working for many people in our economy. There would be people who would be willing to pay more for a house now because the payment is lower than if they paid that much with a 30-year. I don't think it would even be slow. I think it would probably happen in a year or two, and it would transition our whole market to higher prices and longer mortgages over time. This is one of the solutions that I don't like, because this is why it gave me this pit in my stomach, is because it's a solution focused only on the demand side of the problem, the demand side of our housing market. And quite honestly, we do not have a demand problem. We have a supply problem. That's why house prices are high and have not come down. Okay, another one that's been floated that may or may not happen is a cap on credit card interest rates. When this came out, when they announced this last week, all the bank stocks took a dive. None of the banks like this, right? Because it's going to hurt their profitability. But the reality is that it's going to require an act of Congress. It's not going to happen anytime soon. Even if it is enacted, I'm really not sure how it's going to make a big difference for home buyers, at least not first-time buyers. Most of the first-time home buyers that I know of, they're not drowning in credit card debt. They're young. They maybe have a car or two, and they're working toward finishing school and buying a home. They're saving up money. They're getting in their degree. There's just not a lot of credit cards involved. Now, the people who do have a lot of credit cards also have a house, and they've had more kids and more life has happened to them where you've had to put something on a credit card that you didn't intend to. And if you were to lower their credit card payments, it would help them. And what would they do? They would become buyers, and they would compete with the first-time buyers who don't get any benefit out of this. So now you have more competition driving up prices on homes. Again, here's another one. This is another example that ignores the supply side of the problem and instead makes the demand problem worse. Okay, another proposal that's gaining some traction is to allow us to tap into our 401k accounts for buying a home, for a down payment on a home. Already, there are rules that allow you to take up to $10,000 from an IRA account without paying a 10% penalty. And Trump's proposal is to do something similar for 401ks. Right now, you can't do that on a 401k. Now, it's a pretty vague proposal. They haven't said, as far as I could find, how much you'd be able to take or exactly what the tax savings would be, what they want to allow. But in some sense, I'm in favor of this. If you think about it, the $10,000 rule, they made that rule in 1997. So what is that, 30 years ago? When the median home price was $125,000 to $140,000. Today, the median home price in America is $415,000, and in Utah, we're in the mid-500s, depending on what source you look at. So I think it would be good to modernize this, if nothing else, to just get the dollar amount to be more in line with what it takes to buy a home. You know, down payment on a conventional loan, we talk about this all the time, is 3% for first-time home buyers. So if you're buying a $500,000 house, you need $15,000 to buy a home. So I think it would be good. I think it would be good to raise the number. Honestly, I think it would be good if they tied it to the median home price, so you don't have to ask Congress to change the number every year. It just automatically would go up based on 3 to 5% of the median home price. honestly, a lot of first-time homebuyers do have small 401k accounts because they open them up to take advantage of the employer match that was offered when they started their first job, right? Not many first-time buyers have IRA accounts. So I think this would actually help. I think it would be good. And there's a hidden reason why I love this is because it would allow buyers to get a cheaper mortgage. Right now, if you can come up with your own down payment and not rely on borrowing that down payment from a zero down lender like Utah Housing or any of the lenders that offer zero down, you're going to get a much better interest rate, lower closing costs, and a much lower payment. So I like it. Even though this one is only focused on the demand side, it doesn't do anything for the supply side. I still like it. I still think it's something that needs to be modernized. And the ones that I really hate are the ones that are instant, nationwide, lower the cost for everyone involved, because all that's going to do is raise the price for everyone involved very quickly. All right, let's look at some of the stuff that's happening today and that's already happening very fast. And the first one I want to focus on is Trump's pressure on the Fed. The current administration is pushing hard for lower interest rates from the Fed. Honestly, I think the Fed is already lowering rates at a pretty good pace. It's a quarter point pretty much every time they meet. I think it's smart to be measured on that. I understand why Trump wants to see it happen faster. He really wants our economy to go well, and also that affects how much our government pays on debt. And I think he's really hoping to balance the budget and be able to say, that our income is higher than our expenses. And a big part of our government's expenses right now is interest. So I understand it. In May, we're going to get a new Fed chair. So we might see an increase in the pace of rate drops, but you got to remember there are 12 voting Fed governors, and those aren't all getting switched out, right? We're just getting a new chair. Already, though, rates are down 7.5 18 months ago to 5.9, 5.8 for some buyers today. That's a 1.5% reduction in interest rates over the last 18 months, and it has made a big difference already in affordability. It's not all happening because the Fed's lowering the rates. That doesn't correlate quite that well, but there's just a lot happening in our market. We'll talk about some of it that's already driving rates down. Now, if we get much lower, there's going to be a boom in housing demand. If those rates, I believe, if we go into the mid to low fives and the prices are going to start going up fast because there are so many people, you're probably one of them, who's waiting for rates to help the payments, right? And when that happens, there will be a lot of buyers coming out of the woodwork and prices are going to go up because of that. That's my opinion. So my advice is to buy on the front end of this, which is now. And the lower the rates go, the more your home will appreciate. And in the future, I can help you take advantage of lower rates. If they come, we can refinance you in the future to those lower rates. So, not all of this is bad, right? Lower rates would drive up home prices, but if you own a home, you kind of want that. Some other things that are happening right now to lower the rates and to help our market. Fannie Mae and Freddie Mac have been instructed by President Trump to buy $200 billion in bonds, mortgage bonds, back. It's their own bonds back from the market. This already had an instant effect. As soon as it was announced, the bond market reacted well. Mortgage rates went down about 1/8 in the days following that announcement. This has been done in the past. The Fed, over the last decade, has done large-scale bond buying. They called it quantitative easing, if you want to look into it. And it was a huge part of driving rates down after the 2008 crash. When the Fed already had interest rates at zero, they had to come up with other ways to drive bond rates down and to stimulate the economy. So they started this quantitative easing, buying mortgage bonds. Over the last year, the Fed's been doing the opposite. So they've been selling their bonds. They call it quantitative tightening. And that was actually kind of like a headwind on the market that kept mortgage rates higher, even though they were dropping the Fed funds rate little by little. Well, that ended in December 1st. The Fed stopped selling bonds, and now you have a different part of the federal government, Fannie Mae and Freddie Mac, who have started buying bonds. So all of that translates to kind of wind at our backs to push rates lower over time, regardless of whether or not the Fed actually lowers rates. Okay, so that's a good one. I like it. I like rates to go down slow. I don't think it would be very helpful if rates dropped instantly. I think what it would do is it would just create a frenzy. You'd have 10 buyers chasing after every house, just like we did back in 2000. Prices would get out of hand quickly. So I'm in favor of rates coming down. I love it. It helps my personal bottom line quite a bit, but I'd like to see it be measured so that it doesn't have too much of a negative consequence on our market. Okay, another one that's happening now, sort of, is an institutional investor ban. Trump has said, we don't want large institutions buying single-family homes in America. Honestly, that's been a pretty common theme. Almost every talking head for the last year has agreed that this is needed and that this would help. I think it's one of those 80-20 issues that we can all kind of agree on. For now, however, it's only a presidential order, right? It's an executive order. Government agencies like Fannie Mae and Freddie Mac are prohibited from helping these investors acquire homes. That's about as far as the president can go. He doesn't have the power to just ban an open market transaction, right? So he's banning his institutions from helping these investors, but there's not much. I mean, a hedge fund doesn't need government help to buy homes, right? They can just go pay for them or use their own financing. Eventually, what we really need is for Congress to enact the ban. And some people are pointing out that the actual percentage of institutional investors that own single-family homes is very low when you look at the whole market. But it's really about how it affects local markets. These institutional investors, some of them are international institutional investors, they do their research, right? They seek out good housing markets, undervalued local markets, and they start buying in that town. So some markets have really low sales volume. And, if there's only 50 transactions in a month in a certain market and an institutional investor wants to come in and start buying, you have a lot of competition, and it's going to drive up prices in that market, and it has happened quite a bit. It was an interesting quote from President Trump when he was talking about this in Davos I think it was yesterday. He said, many of you are my supporters. I'm sorry to do this. He's talking to these international investors, right? He says, I'm sorry, but you've driven up housing prices by purchasing hundreds of single-family homes. America will not become a nation of renters. We're not going to do that. I think this will help over time, and I do think there's a good chance that this bill could get support from both parties and actually pass. All right, something else that's happening right now, it's been happening for the last year, is a reduction in regulation on the mortgage industry and on the finance industry in general. If you know what the CFPB is, it stands for the Consumer Finance Protection Bureau. It was created in response to the 2008 market crash that was kind of, the mortgage world was kind of the center of that crash. It caused the Great Recession. And so the result was heavy regulation on our industry. It created a whole new class of mortgages and basically incentivized banks to do normal mortgages like 30-year fixed rates and not interest only and not variable, not prepayment penalties. And incidentally, this is the regulation that makes it impossible to implement a 50-year mortgage right now. It'd have to be changed, right? Well, since Trump's inauguration, the CFPB has been downsized. This is the major regulator for our industry. They put in a new chair, and he's someone who actually wants to abolish the CFPB. This is the same thing Trump did during his first term. Of course, they can't just abolish it. They would need Congress to do that, but they can run it like it doesn't exist, right? And they are. And the result is lower regulatory burdens on lenders. They can save a lot of money in legal fees, compliance fees. I mean, translated, they're paying a lot fewer attorneys and a lot fewer penalties these days to the government. Theoretically, these savings would be passed on to consumers, but I'm not sure if that's really happening. Mortgage lenders are actually still losing money on closing day. They operate, the cost to originate a loan is very expensive for them, and it takes them 6 to 12 months to recoup the cost after closing. Incidentally, this is one reason why they find it easier and cheaper to buy their loans from brokers like me, because we just do it a lot more efficiently, and they can eliminate all those costs in the acquisition of a new loan. Okay, here's another one. Congress has passed the Affordable Homes Act. Finally, this is something that addresses the supply side of the equation. Now, it only affects manufactured homes, but it has passed the House and the Senate, which is rare these days. And what it did is it repealed the Department of Energy rule that was over-regulating manufacturing of homes. And I'm not talking about stick-built homes that we see going up. These are manufactured homes that would come in on a trailer and be placed on a foundation. And if you're looking to buy a manufactured home, which makes a lot of sense in our rural communities, this should really help you because it removes regulation and it should drive the cost down of these new manufactured homes. Okay, now I want to talk to you about some things the government has been doing for a long time. These are not new, but the government does do things to help us. And I think the biggest one that nobody talks about is the loan level pricing adjustments. So you'll hear this called LLPAs in the mortgage industry. And what they did is they created this mechanism years ago to adjust the interest rate at the loan level. This means different buyers can get different rates depending on their own qualifications. For example, a lower credit score and a lower down payment would result in a slightly higher rate, and vice versa. Condos can be more expensive to finance than a regular home because they can adjust the loan price, the interest rate at the loan level based on the individual qualifications and the individual property. Well, one thing they have done with this to try to lower rates for first-time home buyers. So they actually waive all of the loan level price adjustments. Any of those adjusters get waived for any first-time home buyer whose income is under the area median income. Now, you have to actually request this. It doesn't just automatically happen. We have to make sure we lock you on the right program that gives you that waiver of the loan level price adjustments. But it can save you a lot. Most of the people who qualify for this are getting an 1/8 to 1/4 better interest rate. And I wanted to just tell you what those income limits are right now in Utah. So as of the time I'm recording this, which is January of 2026, the average or the median income in Salt Lake County is about $121,000. The median income in Davis and Weber County is $123,000. For Utah County, it's just under $119,000, and then most of southern Utah is around $100,000. So if you as a household make less than that, or if we can do your loan by leaving some income off the application and keep you under that limit, you will get a slightly reduced interest rate if you're a first-time buyer. It's usually, like I said, an 1/8 to 1/4 better. Now, if you're under 80% of those limits, so if you're making like $87,000, $90,000 or less, you'll get even more help, including reduced mortgage insurance to drive your payment down. Now, none of this is new. This has been around for years. This same mechanism was used during the crazy times when rates were super low and we had all this demand. We had all these buyers fighting over homes and driving up prices. They increased the rates for people trying to buy second homes and investment properties. The rates went way up for them. And it's not that the market changed. It's just that those loan level price adjustments, I think the government realized these are levers they can pull to either help first-time home buyers, hurt investors, make it harder for investors to compete with first-time home buyers. And I like to think that they were doing it to help, but I also think they were doing it to make more money, right? It's a profit-taking measure and also probably a risk move. They were getting too many investors buying homes and not enough regular homeowners, and they didn't like the way that balanced their risk or imbalanced their risk. So that was cool. That's when I kind of realized they have a lot of levers to pull. There's a lot of things they could do just with the mortgage pricing to make it cheaper for first-time buyers, cheaper for those with income under the median income, and at the same time more expensive for investors or people trying to buy vacation homes and things like that. So already the federal government does a lot that makes sense to help first-time buyers in our market. There's also a lot that state governments do, county and city programs. I've got episodes about this already that you can go look to for different down payment assistance programs and things. I do want to highlight a few of them. Utah Housing is a good one. I know I always mention that it comes with a higher payment than if you can come up with your own down payment. But it's been around since the 70s. It's helped a lot of people succeed as home buyers, and it's something that we'll always look at with you. Now, the other one that I really like is the one where the state of Utah came out a couple years ago with a $20,000 grant. It's not a grant. It has to be paid back. So it's a $20,000 home buyer assistance program that is only available if you buy a new home under $450,000. But the cool thing that it did is it encouraged builders to build affordable units. Most of these are like townhomes. It also encouraged buyers to buy them, right? And it was good. I think it helped on the supply side. It helped generate more supply of housing units for our market to avoid price increases getting even worse. The big downside of that program, and I've been pretty vocal about this, is that they tied it to a Utah housing mortgage. You can only get the down payment help, the $20,000, if you take a Utah housing mortgage. Well, Utah housing mortgages come with higher interest rates than anything else that I could help my clients find. And my wish for them, if they do renew this, it's coming to an end eventually. If they decide to renew it or come out with another version of it, I hope that they would make it available to any first-time buyer that buys a new home under that price range, regardless of where they get their mortgage, because you had a lot of people who were well qualified for a nice, cheap, conventional mortgage, but they took an expensive Utah housing mortgage so they could get a $20,000 loan that they thought was a grant that they have to pay back later, right? So just a little tweak on that program, and it could be really cool. And you already know the cities and the counties like Davis County and Utah County have some really great programs, huge down payment assistance programs. These are $40,000 and $50,000 programs that can help you cover your down payment. But more importantly, it's not just about getting you in the door. It's about lowering your monthly payment. A lot of other cities like Layton, Ogden are ones that we do a lot of. They have a $10,000 down payment assistance program that's similar, right? And the thing about those, the reason why those don't hurt our market is because they're only available to a small slice, right? There's income limits. You have to be under the income limit to get these down payment assistance programs. You have to be a first-time home buyer, and there's limited funds. So it doesn't drive up prices to help the ones who need the help on a limited basis. What I'm afraid of and what makes my stomach turn is when you have the federal government trying to lower the monthly payment for everyone across the board, because what that's going to do is it's going to raise the price for everyone across the board, and I'm not sure it's a good idea long term. Now, I promised to get to this topic. How does all of this affect you? What should you do about all of this? One thing that I'm big on lately is encouraging the younger generation, including my kids, Gen Z and millennial age kids, is to stop focusing on society so much. Stop focusing on fixing society's problems and being so concerned about politics, and instead start focusing on making your life better. You can't change the world, but you can change your world. And so my advice is to put your head down and work hard within the system. Spend more time focusing on succeeding within the system and less time focusing on changing the system. For this conversation, we're talking about mortgages, we're talking about government help. Here's what that means. If Trump announces 10 things, all that will help lower costs for home buyers nationwide, take the help. Take the help, and take it soon. If these moves are going to cause house prices to go up, then get in early, right? If the tide is rising, you want to be in the boat, not on the shore trying to figure out how to stop the tide from rising. Now, to some of you that might seem cynical. I don't believe it is. I believe it's pragmatic and it's important. Spend less time with your head up, looking around at all the world's problems, complaining what the system has done to you, and more time with your head down. I can tell you that I am meeting with young families every day who are doing just that. They're just focused on their life and their success, their savings, their education, their family, and they're doing great things, and they're able to buy a home and take that step and improve their personal finances over the long term. So increase your earning potential, save money, learn about all the home buying help that you can. And I'm here to help you with that. There's going to be lots of new episodes this year all about these things. Take advantage of everything that's offered. Take care of yourself, take care of your family, build stability in your life through hard work and smart money decisions. Focus on that because that's what's in your control, and it's going to lead to a happier life today and in the future. And maybe someday you'll be in a position to change the world. Now, this is coming from a guy who has lived through nearly 50 years in this world. My industry has been at the epicenter of most of our turmoil in our economy over the last 2 decades. I've seen the political pendulum swing from left to right and back and forth. And one thing I've learned is that the political messaging is all about fear of the other side. But the truth is, not much changes. Our political system of checks and balances still works. It slows down a lot of what political leaders want to do, and it does it for a reason. Don't let the economists and the politicians hijack your focus so much. Choose to focus on what you can control. I've benefited a lot from that mentality of keeping my head down, working hard, and I hope that you'll see the wisdom in it. I hope that I can help you with that. If you have questions, if you need guidance in your situation, I would love to chat with you. It's always free to call me or set up an appointment to go through a consultation and look at your home buying options at an individual level, and welcome your call. Anyway, thanks for listening. I hope this was helpful. I hope we can do it again soon.
Thank you for listening to the Utah Homebuyers Quest podcast with Nelson Bars, your place for a strong dose of inspiration and knowledge so you can stay on top of your quest for home ownership. If you have a question or comment for the show, we'd love to hear from you. Visit homebuyersquest.com to record a voice memo or submit your question. You can also join our Facebook community to interact with experts and fellow travelers. Search Homebuyers Quest on Facebook to find the group and join the conversation. But with just a simple click to subscribe, we'll invite you back to the next episode. And remember, we believe in home ownership and we believe in you.